Good afternoon, everyone. My name is Dmitry Pugachevsky. I am head of research of Quantifi, and welcome to webinar Cost of Collateral for Clearing. We will look at cost of clearing, especially cost of funding for initial and variation margins. We will introduce cost of funding for initial margins, cost of funding for variation margins, which we abbreviate as IMC and VMC, and we will run some tests. Quantifi is leading provider of risk management and counterparty risk systems, and our main main focus are calculation tools. So we'll look at some results for real trades, for interest rate swaps, for OTC trades first, and then we're comparing costs of OTC trading with cost of clearing. And then we will talk about why we think OTC trading will continue and what's happening between OTC and clearing funding costs and how they converge. So March 10th and June 10th last year, there were two first deadlines for mandatory clearing for category 1 and 2 swap dealers. These two phases, especially the first, had problems because of unpreparedness of dealers. But the third deadline on September 9th, which was deadline for category 3, smaller category of pension plans and investment managers, passed almost unnoticed. On this day, by the way, the volume of cleared US-denominated swaps reached 265 billion. At the same time, the volume in the bilateral OTC market was just 45 billion, 6 times less, I'm sorry. Unresolved issues still remain. For example, regarding cross-border controversy on whether non-US clients can operate in US markets without complying with Dodd-Frank. This can affect counterparties which are exempt from mandatory clearing under their home rules, but still would have to clear when trading with a US counterparty, where the exemption does not apply. Nevertheless, clearing became a reality, and at the same time, so did costs associated with it. These are cost of funding initial and variation margins, and also funding 2% contribution to RWA, risk-weighted asset. Analyzing this cost became a very important tool of collateral optimization. Let's talk first about initial margin. Initial margin is a capital charge calculated by CCP daily and is based on the whole netting set with the CCP. So in principle, a new trade can decrease the margin. It is protecting CCP against default or gap risk of client portfolio. Initial margin is evaluated as VAR of the portfolio, actually as the worst loss for, or expected worst loss of the CCP, which is facing this bank. For example, like 99% confidence on 10-day horizon VAR. Usually it is calculated as a historical VAR on shifts of underlying market factors, but could be simulation-based as well. To evaluate total cost of clearing, it is very important to know not just current initial margin, but to estimate total cost, initial margin cost. This is total cost of funding initial margins for a life of the portfolio of trades with CCP. To evaluate IMC, one can assume that portfolio is changing just by aging. Thus, one can calculate future time initial margin by shortening maturities of all trades. Then one can either use the same Monte Carlo simulation for all market factors or the same historical shifts and recalculate initial margin. Finally, to quantify or monetize initial market cost, one can monetize initial capital charges using either return on equity or funding spread. The latter technique is similar to how it's calculated for funding cost adjustment, part of FVA. The problem with predicting future initial margin costs is that many methodologies used by CCPs are still not finalized. As an example, 1 year ago in May 2013, LCH SwapClear significantly changed its formula for swaps. Historical look-back period was extended from 5-year to 10-year to keep a period of stress in September 2008. So initial margin wouldn't drop in September 2013. Other CCPs were using shorter look-back period, but with a floor based on permanent stress scenario, including limit default. Another change was that relative scenario of interest rate shifts were changed to absolute scenarios. The reason was that coming from higher historical rates, relative shifts when applied to today's low rates were understating the risk. Worst loss was replaced by expected shortfall. For example, for 10-year horizon, initial margin will be an average of 6 worst losses instead of a just worst loss. This is a more stable metric. It is recommended for VaR calculations in general. Another point is that since CCP price is used for calculating the initial and variation margin for contribution to a default fund, some buy-side firms have started adopting it for market purposes. This can create dependency of the market on a handful of CCP models. One of them being wrong can have a significant impact. Variation margin. It is just a change in P&L of the netting set with CCP. Variation margin can be positive and negative, but they can be significant depending on market movements. CCPs only accept cash or highly related collateral as variation margin. In stress market conditions where need for cash is highest, unmet margin calls can trigger a liquidity crisis. There is a danger that reducing counterparty risk, CCPs create significant liquidity risk, and that could precipitate the next crash. That makes estimating funding cost of clearing even more important. It is very important to relate valuation margin cost, VMC, which is a total cost of funding variation margins for a life of the portfolio of trades with CCP. To estimate VMC, one has to use computational similar to FVA, funding valuation adjustment. In fact, while FVA is a cost of funding for hedging trade, VMC will be a cost of funding of an original trade. Thus, it is proportional to negative exposure, when FVA, or rather FCA, funding cost adjustment is proportional to positive exposure. Also, netting here should be done on portfolio of trades with each CCP, while FVA is done on netting set of all hedging trades. But other FVA computational aspects, probability of own default, wrong way risk between funding spread and market factors should be applied here as well. One thing which is different here is that since there is no counterparty risk, there will be no probability of survival for counterparty, which is part of FVA calculation. To evaluate total cost of clearing or funding of clearing, one has to add IMC, VMC, and cost of 2% contribution to RWA. One also has to be able to do this calculation on incremental basis for each new trade. Netting for IMC and VMC should be done based on a current portfolio with CCP. Then one can optimize cost of collateral by choosing different CCP or CCP member. One point is that for IMC and VMC, it is very important to be able to model wrong way risk. Since it defines relationship between funding spread and market factors, one can use wrong way risk to express views and run scenarios of liquidity risk. Let's talk now about something completely different. So we are talking about clearing, but to compare cost of clearing with cost of OTC, let's analyze first cost of OTC trade. It's already done by banks. It's done by their cross-VA desks with the help of cross-VA desk. Front office desk can now estimate if trade is profitable even before executing this, especially before executing this. So before deciding on executing the trade, bank has to consider its profitability. From traditional mark-to-market, one has to subtract bilateral CVA, which is a cost of default of counterparty and oneself. FVA, funding valuation adjustment, which is a cost of funding of hedging trades. Regulatory costs, which are related to default and CVA volatility. First part, regulatory costs related to default are Basel II RWAs, and second part, regulatory capital related to CVA volatility are Basel III CVA VaR, which was added in 2011. one can optimize adjustments and costs by choosing different counterparties or applying CVA hedges. Profitability analysis should be done with all valuation adjustments and costs calculated as incremental quantities in relation to corresponding netting sets. Here, just to remind you, netting sets should be very different from netting sets which we deal in clearing. For CVA, it's netting sets based on counterparty. For DVA, it's netting set of the whole trade of the bank. For FVA, it's netting set of hedging trades. But bilateral CVA and FVA are expressed in money terms. Their valuation adjustment in dollar terms, which can be added or subtracted from mark-to-market of the trades. While risk-weighted assets, or Basel II capital charges, and CVA VaR, Basel III, are capital requirements. So they basically tell how much capital you have to allocate against this new trade. How to reconcile them? To monetize capital requirements, one can use accounting practice which multiplies capital by return on equity. And to take into account total cost during the life of the trade, T capital additionally multiplies by T over 2. So we assume that today's capital charge gradually goes to 0. That's why we multiply by T over 2. Which means that capital cost will be regulatory capital multiplied by return on equity multiplied by T over 2. But this would be inconsistent with how we calculate funding cost adjustment, FCA, which also arises from a requirement to put down capital. In our calculations, we will use the same borrowing spread SB as is used for FCA. Then capital cost will be regulatory capital multiplied by spread SB multiplied by T over 2. This borrowing spread can come from 5-year CDS, for example, like was mentioned by JP Morgan in January for when they reported their first FVA. Another useful practice, especially for swap, is to express all cross VS and capital cost in terms of par rate adjustment. So we ran tests to analyze contribution of each cost. We ran tests for 3 USD interest rate receiver swap with 10-year maturity. We assume that rates are flat 2.7% and consider 3 swaps. At the money swap with coupon 2.7%, in the money with coupon 3.5%, and out of the money with coupon 2.2%. We consider 2 flat volatility scenarios, market vols 25% and stress vol scenario 50%, vol doubles. For counterparty risk, we assume that counterparty spread is flat to 100 basis points, own spread is flat 100 basis points, both recoveries are 40%. For FVA calculations, we assume that borrowing spread is 1%. This is the spread at which a bank fund its borrowing costs or the capital which it borrows. And we assume that lending spread is 0, so there is no funding benefit adjustment. So all funding valuation adjustment is just the cost, no FCA. For calculating risk-weighted assets or Basel II capital requirement, we were using internal model methods, and we applied Basel III adjustment to IMM when CVA is subtracted from exposure at default. And then we use the formula which we discussed before, like for funding costs, we assume that RWA capital cost is 8 per RWA, and this is the amount of capital which you have to allocate, and then the cost of this will be spread multiplied by time of this or maturity of the trade divided by 2. So we assume that you will have to allocate today 8% of WA, and then this is capital will gradually go to 0 in 10 years. For evaluating CVA VaR, we were using standardized IMM formula. assuming counterparty rating BBB and weight 1%, and then cost again using formula as above, multiplied by SB, multiplied by time, divided by 2. Each cost and valuation adjustment was converted into positive par rate adjustment, expressed in basis points, required for compensating for this cost. For this conversion, we were using market DV01 8.74. So obviously, when we look at totals, which is the rightmost column, one can see that the most significant cost in terms of trading this interest rate swap is for in the money. And one can see then that for in the money, bilateral CVA, funding valuation cost, and all regulatory costs are bigger than for at the money or out of the money. For at the money swap, interesting point that when we double volatility, we see that almost all costs, all costs are almost doubling. So that basically increasing volatility has the kind of linear effect in terms of increasing costs. We, for regulatory capital costs, we used a 1% spread. Obviously, if we use ROE, which can be 8% or 10% or even 15%, then capital costs coming from RWA or CVA VAR can become dominating. Also interesting thing here is that Basel III costs, which are CVA capital costs, are higher than Basel II. That's what we heard a lot, that Basel III CVA VAR basically is very punitive and adds a lot of capital charges. If we look just on the in the money swap, one can see that, as I mentioned, all costs are higher than for at the money or out of the money swap. Another thing is that volatility doesn't have much impact here because it's already extremely in the money. And here is interesting, regulatory costs are higher than FVA. Why we compare regulatory costs and FVA? Because they both come from funding. If bilateral CVA comes from counterparty risk and basically can be considered as a part of the price, then FVA, though it's controversy, of course, should it be passed or not passed, but FVA and regulatory capital costs, if you consider them as costs, you can basically consider their contribution, and we see that regulatory costs are higher than FVA. Now let's apply, let's consider same three swaps, and then let's apply a similar methodology for analyzing cost of clearing. So we run the same tests for the same interest rate swaps and same two volatility scenarios, but now we calculate IMC, VMC, and cost of 2% RWA contribution. For IMC, we first calculate initial margin as a 10-day 99% Monte Carlo simulated VAR. So as I mentioned, initial margin is a worst loss, which is analogous to 1% worst loss of VAR from the point of view of CCP. If you have the system which simulate your prices and calculate pay fee, then this is just today, to business day, or 2 week 99% pay fee. Then we use the formula which we already discussed. We take today's initial margin, multiply it by borrowing spread, multiply it by time, and divide by 2, where time is 10 years and for borrowing spread is 1%. For variation margin cost, we use FCA-like calculation. But while FCA, funding cost adjustment, is a cost of funding hedge trade, VMC is a cost of funding direct trade. So basically, if you have the system and you already calculate FCA, then you have to just flip the sign of your trade, and the result will be your VMC. The only other difference is that for VMC, we don't multiply exposure by counterparty survival probability. While for FCA, we do this because if counterparty defaults, then the whole trade unwinds and you sell your trade. But you still multiply both FCA and VMC should be internally multiplied by your own survival probability. As in OTC profitability analysis, each funding cost was converted into positive par rate adjustment. So if we look at this table, first of all, we see that 2% RWA is the same for all trades and all volatilities, which is intuitive and correct. But for the rest of the costs, IMC and VMC, for at the money, again, doubling falls, double your costs. Again, because this is something close to at the money option, which is almost linear in terms of volatility. And for initial margin cost, since it's calculated as a percentile of 10-day change of the value of portfolio, what is important here, the change of the value of portfolio. It is almost the same across at the money, in the money, and out of the money swaps, which means that basically if you calculate PFE 99%, you have to subtract current PV. Then you will get correct initial margin. And then basically it will be almost the same because sensitivity of DV01 to interest rate is not that high. Basically you will have almost same numbers for at the money, in the money, and out of the money initial margins. This is kind of interesting result. For VMC, for variation margin, one can see for in the money now, VMC is much smaller than for out of the money, while for OTC trade, we saw the opposite. And this is clear because now we consider kind of the trade, which is direct trade, direct receiver swap, while for OTC, we considered FVA, which is funding of hedging trade, which is actually pair swap. So here we have kind of the opposite relationship between in the moneyness and variation margins or funding costs. If we put two tables kind of next to each other and compare them, so for at the money swap, cost of OTC and clearing are very close. That's kind of amazing. And we see that they come from different sources, but in the end, results are very close. Another interesting thing, like for at the money, we kind of expect, because exposure, positive exposure and negative exposure are very similar for flat curve and flat wall. We could expect FVA and VMC to be close to each other, but we see that FVA is smaller than VMC, like roughly 10–15%. And the reason is, again, that when we calculate FVA, we multiply FVA by counterparty survival probability. When we calculate VMC, we don't do this. So that's important to remember. For in the money, cost of OTC is much higher. So definitely if somebody is thinking about doing this trade, OTC, it can be legacy trade and can be unwind and can be some other type of the trade which is not at the money at current point. So going for clearing will definitely save a lot of costs. But for out of the money is the other way around. Actually, we didn't mention them when we talked about OTC costs, but for out of the money actually and low volatilities or market volatilities, the cost negative, which means that basically it's kind of beneficial to do this trade. The reason is like bilateral CVA is negative, which means that DVA is higher than CVA. So that means that instead of basically each of these results, like for example 3.7 for left table for at the money volatility 25%. This is the cost of OTC trading expressed in correction or adjustment to par rate. So that means that if our par rate is 270 basis points, so now it will be like 274 basis points. That's what we will require because we receiver, this is swap, receiver swap, we will require higher coupon to be paid for us to compensate for this cost. And for in the money, which has original coupon 3.3%, we require extra 20 basis points. So that's how much costs we incur and how much we want to be compensated for. So once again, for at the money, cost of clearing and cost of OTC trade are comparable, then for in the money, cost of clearing is much less, but for out of the money, it's the other way around. So clearings became mandatory, but OTC trading will continue. The reason is that, as we mentioned, for clear trades, you have to pay initial and variation margins, which require significant collateral, most often cash. They also receive 2% risk-weighted against CCP defaults. Also, many CCPs don't have netting agreements. So two offsetting trades going to different CCPs attract much larger collateral than if traded OTC. While interest rate swaps are cleared, many plain vanilla products like inflation derivatives are not. Thus, any offsets between two books will be lost, requiring larger collateral pool. Large market segments of derivatives such as swaptions, cross-currency swaps, and so on likely remain non-cleared because of CCP eligibility requirements. Some counterparty in some jurisdiction will be exempt, for example, corporate, sovereigns, and pension funds in the European Union. So many participants will have an option to clear or not to clear, and it is important to be able to compare costs of each to choose the most effective way to optimize capital. But interesting phenomenon is going on basically as we speak, converging between OTC and clearing funding costs. Variation margin was always part of CSA, but OTC markets never posted initial margins. The initial margin is sometimes confused with independent amount of CSA. They are very different. I described already what initial margins are. And now regulators recommend banks and big non-financials to post to each other both initial and variation margins on non-cleared over-the-counter trades. This is the big change from the current practice, where collateral is regulated by bilateral CSAs and they are rarely paid initial margins. Some events which happened related to this in September 2013, WGMR, which is a regulatory body, published final rules recommending banks and non-financials post to each other initial and variation margins on non-cleared over-the-counter trades. ISDA agrees to develop a standard industry margin model to be published later. The time is tight with the margin regime to be phased out from December 2015. By this time, this model should be published, it should be developed, should be implemented by market participants, and basically you have to run in parallel your current way of doing things and doing this using putting initial margins using is the standardized model. But definitely this development will lead to reduction of CCR risk and conversion on funding costs for OTC and clear trades. Just to conclude, recent developments impact both non-cleared and clear trades. Cost of clearing can be significant. Quantifying funding cost of clearing is important. Unfunded initial margin and variation margin can lead to liquidity crunch. Initial margin cost and variation margin cost and calculating incremental cost for a new trade, then you can optimize cost by selecting different CCP or CCP member. OTC trading will continue because CCPs are not ideal and because there are significant costs related to them. There is a trend in converging funding costs. And comparison OTC cost and CCPs selection requires a decision tool. Okay, thank you very much for your attention.
Well, as it looks like we don't have any questions for Dmitry, just like to thank him for taking the time out to present that material to us. And as we have finished early, it looks like he'll be able to get back to watching the US against Germany World Cup game. So enjoy the second half. Thank you everyone else for participating. The next Quant Hub webinar will be on the 15th of July, which is a Tuesday. So if you're planning on attending, make note of that. And that will be led by Murad Chowdhury on core risk management principles of banking. So join us then. For now, thank you very much, and we'll see you soon. Goodbye.